Hey, welcome to YBR Capital. Hope you guys are having a great Sunday. This I got some time, and as promised, I'm gonna do some analysis on Indy. So we did Phoenix yesterday. We figured out that hey, that was not the best market to invest in as of now. So let's figure out what's happening in Indy. So without further ado, let's see if Indy is gonna crash or not. And we're gonna do a formal analysis this time. And I didn't find any specific folks talking about it, but this is my analysis. So let's see how I view this. So Indianapolis is a great place. I love it. I go there often. I have friends there, co-workers there. So that's how I got into the indie market. So in 2025, will 2025 be the end of indie and market's going to collapse? Well, for us to answer that question, we're going to look at it from a three-point perspective. First and foremost, get rid of this. First and foremost, okay, so first and foremost, we're going to look at population growth. We're going to look at job market and the job growth there, and then we're going to understand the housing market. And if we are good on all three, then I know we can come up with a prognosis of what's going to happen in these. So let's understand the population growth first. And this is as you look at markets, this is how you kind of go about analyzing it. Is hey, these what are the demands and what are the headwinds and tailwinds. So population is for housing is the most important thing. So, give a historical prospect of people who are not following the indie market. Indie has been growing steadily, but the rate of growth of change is going down. So, as you can see, pre-pandemic they were at 1.5, and post-pandemic they're now at 1%, and the forecast is it's going to go lower and lower. So overall, it seems like it's a stable market and the growth is positive. So those are two things that are definitely going in favor of Indy is okay, it's not going to crash because people are leaving. So you're not going to get a San Francisco, New York, Austin, Florida situation here. You're going to get more of a macroeconomic situation that's going to cause issues here. So on the population side, Indy check a stable population, so nobody is leaving the Midwest that fast except Detroit area and Illinois and Tennessee, Memphis. They're going back to California. All right. So yeah, so we're good over here. So definitely, uh, population growth wise, as you can see, Indy is quite stable on that front. So moving on to the unemployment rate. So again, with stable population and not being influenced by uh, erratic employers or big employers who come and go, like startups or finance org that fire and hire so quickly. Indeed, it seems is the only blip in the last 10 years was the pandemic, and then they quickly rebounded back. And the way they rebounded back, even though they rebounded back in like 2 years, and now they're back to their trend line. I think India is gonna, from an unemployment point of view, is gonna remain stable for now. And let's go to the job market. Who are the employers? So I found it actually interesting because these guys are the ones who are gonna drive the growth. Okay, so it's as I said. At the end of the day, there is base demand, and then there is the second derivative demand, both on a positive point and negative point. So positive point, these are the big employers. They have the ability to hold the fort and increase. So what I found was there's four or five main niches that are happening in India. Those are the growth drivers over there on the employment side. So there's one is health and life sciences. So those are the ones in the bottom. Eli Lilly, Community Health, Indiana University Health. Like these are like the base. This protects the downside of indie job market is these guys are quite stable and they are there for a long time and they are local. So they do provide a lot of jobs and stable good jobs, so that's your base. Then the manufacturing part comes in. The manufacturing is basically Rolls-Royce and Allison transmission. I was kind of surprised, I didn't know Rolls-Royce was manufacturing over there. So these guys are the manufacturing jobs. So from a from my employer point of view, what I'm trying to present is it's a diverse base. So it's not like one sector goes down and Indy collapses. So it's not a Bay Area or a New York or Florida or Austin type of situation. This is like a diversified employment base. And then there is the tech one, Genesis, Infosys, Salesforce. I'm not sure so much about Genesis and Infosys now with the H-1B situation going on. So if they're not bringing in their H-1B employees, nobody's going to spend money. So the way it works is one white collar job creates three blue collar jobs. So there's again, you have to understand, it's like the inception, like one thing causes another. It's a dream within a dream. This is one impact has a second derivative impact, you know and has a third derivative impact. So for example, let's say Infosys brings somebody and they have a high paying tech job, then they need housing. So you got the whole real estate sector involved. Okay, they've got the rental sector involved. They've got the grocery food industry involved. They've got the transportation involved. So that's how one good job creates three blue collar jobs. So they might be a little, but they're not that big. But as I said, we're talking about growth drivers. Amazon and FedEx are the transportation. So the way India is, it's called the crossroads of America. If nobody knew that, a small tidbit. So the way the intersection, the which Eisenhower created for the U.S., and that was to protect in case of invasion. But somehow Indy came at the crossroads from north to south and east to west. So a lot of trucking companies have stopovers there, and there's a lot of logistic stuff going on. So somehow Indy has that little thing going on for itself. So that's why Amazon and FedEx have a very big presence over there. And then finally rounding it up with the finance folks. One America's, mostly they're most of the back office side and the mortgage origination side. So a lot of that kind of work is there. So overall, a good mix of employers are representing all the major sectors. So from a risk point of view, the employment based drivers are pretty good. And then this is just like a big picture of the trend. As I said, health sciences are the majority of the jobs there, so that's kind of stable. And I think that's what's keeping the indie job market situation so good is they've kind of built a base on that. And then as you see, everything else is kind of slowly ramping up with the growth. Technology, as you can see, has gone up a little higher growth. I think it's starting to become a technology hub in a sense, uh, like a consulting hub. That's why Infosys and Genesis is there, Salesforce is there, big tower over there, love it. Actually, we did some when I was at Facebook. So I used to build data centers all over the US before I left Facebook to do other things, basically start my real estate company. But yeah, so I used to build data centers, and I went down to Indy to look at data centers, but we chose Las Vegas. But yeah, so uh, there's some tech starting to develop over there too. And then let's talk about the housing market itself. So first, before we do a deep dive into the housing market and go back and forth and try to understand what will happen, this is to give like a reference of what has happened until now. So historically, as you can see, it's been a very stable market. So there's three types of markets in real estate. One is the hot market, which is cyclical. So you know New York, Bay Area, Los Angeles, Phoenix, these are cyclical markets. They go up, they go down, boom, bust, different causes. Okay. Then they are the hybrid markets. So they kind of are stable, but there's periods of boom and bust. So if you remember the one I showed you about Denver, now it became a hybrid market. There was nothing happening in the first housing bubble, and then it jumped up. So that's like a hybrid market. So there's things that cause it to move, but it's like places like Indy with stable population, stable job rates, stable unemployment, house prices don't go up much. And this is the history of it. As you can see, it's pretty straight trajectory after the 2008 housing crashes. Also, as you can see, didn't change much, you know, and then just went down a little and then slowly kept going up. And then we see this post pandemic boom. Wow. this is kind of scary. So as you can see, it's like the last 100 years, a market has been this stable, and this is just showing the last 25 or 30 years, but uh, the last 100, there's been a linear market, and now suddenly it has jumped up. So there is, as you can see, population has not changed, job situation has not changed, the population demographic has not changed. The only thing has changed is the house pricing has gone exponential. Like this shows financial engineering at work. This shows investor activity at work, and this shows that people are leveraging up. So people are stressed in Indy, given the fact that wages haven't gone that high, but rents. And this is the story of the all the U.S. markets. So as you can see, everything is good except when we come to the housing market, it seems a little frothy. And let's analyze this more and see if it's going to crash or not. So moving forward, so I did like a heat map and figured out. So each area of Indy, like each zip code or each county, is like it's like a own little uh, sub-market. So like you just can't be like, hey, I'm gonna go to India and invest there and said that hey, that place is good. No, every place is different. Okay, like over here in the north, like Fisher, Carmel, these places, these guys are like the really expensive places. Very one of the like voted the best suburbs to live in. Rentals do not cash flow over here. What I'm showing here is the growth in rental markets. Okay, so the ones in red is where it's hot, and ones in green is where it's not that hot, and that makes sense because like these areas, these places, it's mostly homeowners who live here in the green parts. There's not much rental growth, but where the rental growth is happening is the slightly blue collar, lower income in the middle. New investors are coming here like crazy. Some suburbs are building out; they're building apartment complexes. So that's where the rent growth is happening. So this is kind of giving you like a heat map of within Indy, what are the rent growth areas and where the rent is kind of stalling, or which are like the mature areas. So, and as you go further away from that into the rural area, it's not gonna change. Like, there's like one house with a 5 acre plot, and the next house is like 10 acres away. Like, over here, it's like, you don't want to, like, you can invest here, but you're not going to see any growth potential. So that's the thing about linear markets is there's no appreciation. So you get cash flow, but there's always a catch 22, right? Like if you are not getting appreciation, you better get your numbers right because if you overpay, the market is not coming to protect you. And as we saw over here, all the appreciation that would have happened linearly in the next 10 years, let's say from 2020 to 2030, the market will have gone up by 3% each year. So cumulative, 3% each year will be over 10 years will be like 38%. And this is like all that has already been baked in. So this is like 40% up. So if you just do a simple linear progression, the market should be around 240. It is at almost 300. So there is a delta between the natural valuation or the natural value of a house and now the pushed up value. So there is definitely a risk in the valuation, and again it's going to go to these specific areas. So indie market is very tricky, as you can see, and I know this because I spent so much time. I've been investing there for almost 3 years now. I know almost the zip codes, the areas. I drive around there. It's so tricky. Like once you go like over here, it's like it's even trickier because it's different by the it's like Brooklyn. If you, I lived in New York too. I went to NYU business school there. So, like it's like Brooklyn, where you have like a great brownstone. And it's like amazing, and like 2 street down, it's like holy shit. Is it safe to walk here after 10? Indy, the middle part of that is kind of like that. So you have to be very knowledgeable, or you need to have like a very good realtor and a PM who's going to help you out over there. So yeah, so that's what's going on in Indy. And so now that we established that, hey, the indie market is like the macroeconomic picture of indie is good, but there is some valuation issue in the indie market. So how do we resolve that valuation issue of the indie market? And let's go and look at some live data and see if we can figure out. Where are you? Okay. All right. So let's go to Altos research. So what we're gonna do is we're gonna see what the inventory situation is like right now, and we're gonna make a final conclusion. So this is Irvine. We don't want this. We want this is a great site actually. If you don't use this, Altos Research, they update the data, and it's quite decent. Yes, we go here. Yeah, let's view the report. So yeah, there's a slight seller advantage as per them, and it's kind of stable. And the way to understand certain markets is some markets are single family heavy, some markets are condo heavy. So if this is a single family heavy market, but now with condos coming in, you want to check that. And as you can see, they are almost, in the buyer's market. So, like, there is downward pressure coming from all the building that's going on in Indy. Again, everywhere is the same situation where, last time we discussed Phoenix, yeah, it's the multifamily units that are coming online that's pushing the rents down. And as you can see here, the rents are kind of on the downward trajectory on the condos. If you look at the housing rent, it's also on the downward trajectory because, as condos are offering discounts and are cheaper, people are like, let's just stay there, until we buy a house and rates come down. Why buy, until there is like a pressing need to have a house, and they're like, hey, I'm gonna be here for a long time. I would rather spend $100 more and just get a 3 bedroom something. So let's look at the inventory and what the inventory is doing. So single family, as you can see, it is growing. It's still not back at the pre-pandemic level, but it is growing. So the good sign is this is going to be a stable 2025 just based on the inventory. But let's just do a double click and understand, where other inventories and pressures can come from. So, but if you go to the condo market and we look at the inventory over there, and once this updates, you can see what I was talking about. It's these condos that are coming online in bulk, and these are the ones that's going to cause, downward pressure because it's a substitution impact. Like, let's say, for example, coffee becomes $100 a cup, then the substitution impact would be people will go drink tea, right? So if houses are expensive, people are going to buy condos, and 2 3 bedroom condos just because you're sharing a wall doesn't, for a young couple is not going to, be that big of a deal breaker. Yes, there's some feelings are hurt, but hey, this is capitalism. So from what we gather now, and just looking at this, is there is a slight downward pressure on everything. And inventory, yeah, medium rent is down. Let's check one more thing. Let's just see the market action. That is how hard the market is compared to prior years. So as you can see, yeah, there you go. As interest rates have increased, less people are buying houses, so the inventory is definitely going to be building up, and there's going to be less demand, and it is across all price mediums. So around 250 is the median of Indy. Anything below the median in certain cities, you see it's crazy, but here you see everything is the same, and that goes back to the stable job market because there's no one sector or one area that is growing like crazy or is going down like crazy. So the demand is going to be stable, supply is going to increase, market action says until it becomes affordable, indie people are not going to spend and kind of put themselves at risk. Smart people. So what do we conclude from here, Len? There we go. All right. So, in conclusion, what we understand is Indy seems like a decent market. Deals may be there, but you have to know the market. You just can't go there and buy something because you will lose your money so fast. And there are so many stories I can tell you where there's like an industry out there, PMs, realtors, contractors who just prey on out-of-state investors to come, and they will hose you. So you have to be careful. Uh, and so overall, indie market, YBR Capital can say 2025 indie market will not crash. It will be either flat to 4% increase. Uh, Deals are tough to have because people are not selling. It's a very stable market. If you're looking for appreciation, yeah, you're not going to get that for the next 10 years. So if you're going to invest in indie, invest for cash flow. And if you want to invest for cash flow, you better get your numbers right, understand the market. What you're getting now is basically what you're going to be getting for the next 5 years. So, do your pro forma and your forecasting correctly based on those assumptions. Do not assume 10% year on year rent growth. Do not assume 10% year on year price appreciation. The market is not going to help you. The indie market is going to be, you know, boring and stable if you want to invest there. So that's all I had for today. Just a quick update on Indy. I know this market and I invest there, and definitely I'll be active. I won't be going to Phoenix as I said last time. I'll be going to Indy, and if I find a deal, I will let you guys know. I will upload everything here live so you can understand what it takes to build a real estate business. Hopefully you are enjoying this content. Any questions, comment, feel free to ping me. uh, I answer all my comments, and hope to see you again. All right. Thank you for coming to YBR Capital. YBR Capital, where we get our investors double digit returns, leveraging real estate. Thank you and bye bye.